Elaine mentioned there, the government has 44 recommendations in its hands on everything from superannuation to housing to bank fees. The Financial System Inquiry report may sound a little dry, but it's really not. It has potentially deep implications for every Australian. With me now is the man who chaired the inquiry, David Murray, the former head of the government's Future Fund, and before that, the CEO of the Commonwealth Bank. Thanks for coming in, Mr. Murray.
Thanks, Lee.
As we heard in that story, your report states that housing is a potential source of systemic risk for the financial system and the economy. Can you just put that in layman's terms for us and explain what that potentially means for the average Australian?
Well, housing has been a source of systemic risks in advanced and less advanced economies around the world for a long time. What tends to happen is that the apparent safety of housing from a lender's perspective and the apparent security from an owner's perspective leads people to speculate quite heavily in housing versus other assets. And as the introduction to the program pointed out, if there are incentives in the system to do that over other investments, that can exacerbate the problem.
Drives up prices.
It drives up prices. That does nothing to help affordability of homes. But our inquiry was not able to make specific recommendations on tax. We made observations. We did that because the tax white paper has to consider implications across the whole economy, and we felt that if we were straightforward about effects within the financial system, that would help them balance their view.
In recent years, we've seen many Australians lose their life savings in scandals around Storm Financial and Opus Prime and even the Commonwealth Bank. If your recommendations are adopted, would that protect Australians from that sort of thing ever happening again?
Well, I think it's in this area that we have made a paradigm shift from the previous Wallace inquiry. We thought long and hard about financial services as a product set versus other services in the economy. And we decided that they're just not the same as buying and selling potatoes down at the local market. People can have not so much their lives at risk with financial services, but certainly their lifestyle. And for that reason, we figured that financial services have to be manufactured and distributed differently from the way they have in the past, and there should be much more obligations, much more of an obligation on the people that do that to ensure that they can earn the trust of their customers and build confidence in the system.
So would people be protected under the reforms that you're proposing, such that we wouldn't see those type of things ever happen?
We've said in our report you can't protect people from normal market risk, that's the rise and fall in prices in markets, and you can't entirely protect them from their own decisions. But you can protect them from being sold things that are patently unacceptable for them. And the changes that we've recommended here are a step change, and they go further than the FOFA reforms that government and the Parliament has been considering.
How about the power of the big four banks? Is there anything in your report that would increase competition?
Well, we're concerned that there's a heavy concentration in the banking industry, as there is across the sector, and that's not good for competition. The reason it's arisen with the financial crisis is a normal development. Therefore, whilst we're not alert to any serious problems so far, we believe that we have to up the ante on competition in the system.
But wouldn't having more competition potentially lead to more instability?
It can, but we're very lucky in Australia that our prudential regulator has probably set a high global standard on the quality of supervision. So building off that, we're confident that we can have a system that's more competitive, and that's in the interest of consumers.
One of the things that's garnered the most attention is your call for the banks to keep more capital reserves. Would the banks not pass costs associated with that onto consumers?
They may well do, and if they do, the extent of that is far less than the claims that are being made. We looked at expert reports around the world, and for every 1% increase in the capital of the banks, the capital adequacy ratio, the Bank for International Settlements thinks that would cost about 3 basis points on the interest rate, which is 0.03%. And it could cost more depending on whose view you take. But there are reasons why that may not happen. Firstly, the Reserve Bank takes into account changes in the structure of the banks, their lending policies, their capital arrangements in setting monetary policy. So that can be offset. And in addition to that, it doesn't necessarily have to come from the customers. The rates of return on the Australian banks are very strong. You could reduce those returns slightly and still...
Smaller dividends.
Well, either smaller rates of returns or different dividend payout ratios. And those banks could still fund the Australian economy quite comfortably. So we think the quality of the banks and what they've built has built enough of a buffer for us to build an insurance policy for the taxpayers being dragged into a future crisis, which we think always may occur. And in that case, we want the taxpayers back out of there unharmed.
Just briefly, the Treasurer, Joe Hockey's taking a look at these recommendations and he says that these type of reforms require bipartisan support. Given the current rancour in Canberra, doesn't that doom them right there?
Well, an important observation we made in our interim report was that the politicisation of the finance system can be harmful. For example, in the superannuation system, where there are inequities in a system and distortions, it can be an exciting playing field for politics. And that causes continual disruptive change to the system. And we think that's not healthy. That's why, for example, in the superannuation system, we've recommended that there be bipartisan support for a single objective of that system, and that is as a retirement income system, which is appropriate given that the government gives tax concessions for it.
David Murray, thank you very much for coming in to explain some of that for us.
Thanks indeed.